Yeah, hey Lana, and welcome back. We are back with another video, that is lesson 2, which we'll be tackling in unit 1. So basically what we are talking about in unit 1 is what is Forex trading, and that's the question, what is Forex trading? So we'll be going ahead to define what Forex trading is. So ideally, the term Forex is an abbreviation derived from the term foreign exchange or the phrase foreign exchange, which can be further shortened to FX or spot FX or spot Forex. Spot is ideally the the act of doing something instantly, like it's instant. So spot Forex is actually something that happens within a span of microseconds. Yeah, so once in a lifetime you've heard about foreign exchange, and we'll be going to into further details of what it is. So we'll be going ahead to define what is trading. So trading is basically the art of exchange, that is buying and selling of goods and services. Uh, in trading, we look at one major thing, which is making profits. So that is one aspect of trading, just for the sake of making profits, or maybe an exchange of goods and services. There is what you call barter trade, and then there is a commercial trade. So we'll be looking at trading in this aspect, that is trading of currencies. The basis of it is that every country in the world has a currency, and countries exchange both goods and services on a daily basis. Yeah, so each and every country has a different currency, and if you want to buy goods in another country different from your home country, that is a foreign country, you'll have to buy goods in their foreign currency. So that means you'll have to convert the currency of your country into the currency of that country to be able to be on the same page with them and buy or sell your goods. That is, you might choose to buy, or maybe you want to sell your goods offshore in another country. Yeah. So the Forex market is a global over-the-counter market, that is OTC, where different parties come together, different participants come together. And these participants could be investors, that is both retail and wholesale traders, financial institutions and other business institutions, which are actually big, and banks. Now, banks are one of the main players in the financial trading. So you're that person who banks with your local bank. You deposit and withdraw funds and all that. There is a high possibility, a 95% possibility, that your money is usually used in trading. That is for profit. That is one of the ways with which banks actually earn money. You'd be asking yourself, how do banks earn? Like, how are they able to pay the workers and all that? Apart from other investments that banks make, and also apart from the fact that your cash is partially given out as loans, which bring back profits, and you're given part of that profits as interest, and banks remain with part of that profit as the operational profits. So now, if you look at if you looked at, let's say, the profit that comes out of this in form of interest, it's too small to operate a bank. So how do banks earn otherwise? Banks invest in different parts, and the main investment form is in the forex market. So banks are one of the major players in the financial markets. If you are a retail trader, that is okay, not a retail but a wholesale trader, and you want to trade through a bank, the bank will take the risk of trading for you. So it will be leveraging the risk. When we'll be defining forex terms, we'll be defining what leverage is and how all that happens. Yeah, so all these participants come together to ideally trade. So what do? You just speculate. They speculate, uh, buy and sell different instruments, mainly currencies. Yeah, so what is speculation? Speculation is a major, like, speculation is a major aspect of any kind of business. If you want to do a business, you have to evaluate, like, you come sit down and evaluate what kind of a business is this I'm getting into. You'll try to see if there are other people or other firms which have been into that kind of a business, and you try to see if they've been successful. What are the some of the measures to take to be successful? And doing all that, you'll be speculating, because even after all this, you won't be sure if at all that business is going to work for you as it has worked for all those other parties. So it will all be speculations. So if you want to do any kind of business, you'll first speculate on the returns you are expecting from that kind of a business. You'll just be speculating because you aren't sure if at all person A starts a business in city A, which has a different kind of a population and population density, and person B starts the same kind of a business in another area, which is probably highly or okay, not really highly, but densely populated, as compared to the first city, which is highly populated. You'll realize that the returns won't be the same, but you'll be speculating the kind of percentage you'll be getting out of this business. So that is the same thing that happens with the trading instruments. Let's say, for example, wheat, or even if not wheat, let's talk about coffee. If you want to trade coffee, it's actually one of the trading instruments that are there, both in spot forex and the futures markets. Here we'll be generalizing both spot and futures markets, but mainly on the spot markets. So if you wanted to trade coffee, you'll be looking at different aspects of coffee. Mainly, we'll be looking at the demand and supply of an instrument or a commodity. So the commodity in this case is coffee. We'll be looking at the demand and supply of coffee. What is the supply of coffee? Is it high or low? Is the supply high? Is the supply low? Is the demand high? Is the demand low? Generally, if the supply of an instrument is or a commodity is low, then the demand turns out to be high, because now you realize most people will be in need of this commodity and its supply is low. So when the demand is high and the supply is low, the price goes high. When the demand is low and the supply is high, the price goes down. I think that is basically something, So the art of trading will just be we'll just be speculating in terms of what is, like, let's say, for example, taking the example of coffee, there are times when the supply of coffee is very high. That is when there is there are those times when people are planting coffee, and there are those times when coffee is growing and all that, the process that is taken up to the final part when now people are harvesting coffee. When coffee is being planted, that means its demand is low. When it's being sold, like when it's being harvested. But when it's being planted, that means there will come a season when the demand is high and the supply is low, all through up to the harvest time. So when the harvest time is approaching, you'll be speculating that prices will be low. So if you are a shrewd business person, then you'll be saying that during the high supply, you will be buying this particular commodity or item because the price is low. And when the demand will go high, that is when when the harvest time is over and you're moving on to the new season, the supply will be low, and now this is the time when it will be the prime time for selling. And when you sell this, you extract whichever amount of profit. It depends on the price difference between the demand, the buying and the selling time. So that is ideally the art of speculation, and that's what the Forex market is all about. Yeah, so now we'll be talking about the Forex trading process. The Forex trading process for all trading parties is centrally controlled and conducted by an interbank market. That is a specific online system by which all currencies and instruments are traded strictly for 24 hours in a day, 5 days in a week. So the Forex market is active for 24 hours each day for 5 days. That is from Monday to Friday. Friday at 23:59, the markets close instantly. On Monday at exactly 12 a.m., that is 0000 hours, the market opens, and it will run up to Friday, that particular time. And looking at the Forex market, it's ideally the largest market in the whole world, with the current estimated daily turnover of over $8.2 trillion. That is as of June 2019, taking on the data given by the Central Bank of Canada. Not Canada, but New Zealand, that is the NZD. Yeah, so the Forex market is basically the largest market in the world, followed by the credit market, that is as of 2019, because now things are changing. The credit market is the second largest market, which has a turnover of about 4.5 trillion. Then followed by it's followed by the stocks market. Now the stocks market is quite low and third because technology having moved forward, then it's majorly traded in the spot market. Now it's classified under the spot market. So in this coming to the next unit, we'll be looking at different derivatives, and that is currencies and instruments. That is currencies and commodities that are traded in the market, how they're done. Yeah, so the main interbank network, that is the ECN, the Electronic Communication Network. That is the main interbank network that is centrally used for trading. That is where all banks come in and all market participants come in. It primarily hosts the exchange of trading instruments. The main ECNs available so far are Instinet. Okay, these are just examples of the already available ECN networks. That is Instinet, SelectNet, and the New York Stock Exchange ARCA, which is NYSE ARCA. Instinet was the very first ECN model, which was invented in 1969. That is all we need to know about. Okay, when you come to trading, ECN is basically the safest network you can use in trading. So when you are choosing a trading network, just choose ECN. There are different kinds of networks that are on the markets, but ECN is the safest one so far. We'll see about that when we talk about brokers. So the base and standard currency in the whole world, that is according to, basically when you are looking at the International Monetary Fund, the IMF, the base and standard currency is the United States dollar, and it's actually the main currency with which other currencies are measured. Now, it's when you want to trade anything online, you'll first convert your currency, your home currency, to the US dollar. That's why it's the base currency, and it's from there that you'll be able to trade with other currencies. The strongest currency against, I said the US dollar is the best currency. Now, there are currencies that are quite stronger than the US dollar, and there are some that are weaker than the US dollar. So the strongest one is the Kuwait dinar, that is the KWD, which is where one Kuwait dinar equals to 3.29 US dollars. Now, the weakest currency is the Iranian rial, that is the IRR, with one US dollar being equal to 112,000 Iranian rial at an average market rate. Basically, the strength of a country's currency speaks volumes about the country's economic strength. So when you see a currency devalue or lose value, that means the economy of that country is going low. When you see a currency getting value, like gaining value and going high, that means the currency of that country is going higher. Like the economy of that country is growing. Now, the growth and the growth of a currency or of a country's economy depends on different aspects. That would be the economic values of a country depends on the agricultural produce, the employment rate of that country, things like natural calamities. You see, these are things that negatively impact the country's economy. They impact the country either positively or negatively. Political aspects of a country also have an impact or an effect on the country's economy and the country's currency value. So moving on, the basic idea in Forex trading or any other form of trading is doing analysis, as I mentioned prior. And out of that analysis is what we call speculation. So out of that speculation and analysis, you are able to make a decision, that is a sober decision of what you want to trade, when to trade it, and that is when to get in and get out of the market, that is of what you bought. So taking an example of coffee is a commodity. So if you bought coffee while it's at high supply and low demand, that is a low price, then that is, you'll have made a decision, an analysis, a speculation, and you've known that at this particular moment it would be wise if I bought coffee and wait for the season when it will be primed to sell. So now when the demand goes high and the supply goes low, now you can take the coffee out of your store and sell it somewhere. Now, the demand will be high at that particular moment, so you won't have issues in the market. So when you sell, you'll be selling when the price is high, and the demand will be high, the supply will be low, so the price will be high. Yeah, that is both the spot and the futures markets. When you want to trade commodities, mainly you trade them in the futures market. The futures market is mainly for commodities, and the spot market is mainly for currencies and all the other instruments. Though in the spot markets you can also trade commodities, but then you'll realize that the movement will be too low for you to make enough profits. So if you wanted to benefit very well out of commodities, that means you'll have to be patient enough. Patience can be half a year, or even a full year, or even 2 years, depending on the kind of commodity that you are looking at. Now, if you chose on a commodity, for example, coffee, you will be looking at the demand and supply depends on different things. For example, in one particular season, coffees might be planted, that is the planting season, and then when it comes to the particular time when the coffee is growing, you realize that maybe the weather is good or it's bad. So any good analyst will be looking at the weather and trying to see if the weather is good, that means the coffee growth will be good. If the weather is bad, the coffee growth will be bad. So any seller or buyer will be looking at these kinds of aspects. So if you have some coffee that you've stored in some storage somewhere, then you'll be able to see that after a while, that is after when the coffee is growing and then you see the weather is bad, then you realize that the output or the outcome of the coffee plantation season at the end of the day will be either high or low. So this will just help you to make decisions, all of that. So ideally, the art of trading is buying low and selling high in order to generate valuable profits. So that is the theme of trading. Forex trading, that is spot trading and futures trading. The art of trading is buy low, sell high. And the reverse is also true, in that the spot markets and even the futures markets, now that there is technology, it allows the reverse kind of trading, where you can buy low and sell high. So when you are selling, when the price is high, and it will be a cycle actually. The market will be in a cycle where when the demand is high and the supply is low, it's a cycle, and when the supply is high and the demand is low, it's another cycle. So when you look at it, it moves in a wave kind of a format. That's the idea. So you'll be looking at that technically in the wave system, that is the Elliott-Wave theory, and all that is about that. Yeah, so the art of trading is buying low and selling high, and even doing the reverse now that technology has moved on. Yeah, so finally, a number of you have been asking to see who is behind this whole thing. So the photo above is just like the main idea behind this thing, that we are a team of people, and we'll be unveiling ourselves later in the day. We'll be having a live Forex session. That is a live streaming session actually, where you will be able to, both on YouTube and on Instagram, where you will be able to ask your questions and have an interactive live session, where you'll be able to exchange ideas and interact. Yeah, ask questions and all that. Bring in your suggestions and all that, and we'll be able to build a very big network. So that is what you need to know in the introduction to Forex trading. That is unit 1, and that was lesson 2. So that's it for now. Let's meet in lesson 2. Bye bye.